Yes, absolutely. These are the notes for this session. I also want to mention that who here has heard of Reverse Mortgage Education Week from NRMLA? Okay, well, these are broadcasts sponsored by NRMLA, national webcasts that you can invite all of your referral partners to, whether they're realtors or estate planners or financial planners. And I'm going to be on two of them. I'm going to be on the one on Tuesday and on the one on Friday. If you're familiar with Dr. Wade Pfau and Jamie Hopkins and Dr. Salter and some of the other academics that are writing a lot about reverse mortgages, you're going to find that they'll be on the call. So I would suggest that you get the links. If you don't have that, I probably need to send it out to everybody on Open Reverse and make sure that you can click on the link and register for each one of those, and then send that registration link out to everybody. NRMLA's hoping to get a few thousand people on these calls through Education Week. I'm on Tuesday and Friday. Suzette is on one of the calls as well. Is that the one on Tuesday, I think? Tuesday the 19th, maybe? So just make sure you register for those. I think that's going to be a good educational opportunity, and it's lender neutral. Nobody's going to be highlighted there. Fortunately, they will mention that I'm from Open Mortgage, but this is a great opportunity to just kind of tag on to some of the stuff that NRMLA is doing from an education standpoint. All right, let's go ahead and get started. Today, we're going to explore some of the major financial planning advantages of using a reverse mortgage during retirement. So the format of today's presentation is very similar to what we've already done with some of the others. I'm going to advance some slides to keep the conversation going. I'm going to open up some softball questions for our panelists here, but it is going to prompt questions of your own. Who got a chance to talk to either of these two on the BAT tour last night? Okay, a few of you. Okay, there's a lot of insight at this table, and we want to make sure we can pick their brain. We want to leave enough room for that. And we only have a little over an hour, so I don't want to waste any more time, but I wanted to let you know that these two have a very good understanding of home equity conversion mortgages and how it relates to their industry. They're the minority. A very small percentage of financial planners have that kind of understanding and are open-minded enough to talk to you guys in the first place. So let's get inside of their brains. In addition, both of them have their own radio shows. So they're not afraid to talk to you guys about reverse mortgages. So you can ask them any questions you want without any further delay. Let's go ahead and introduce them. I'm just going to go through a quick bio, and then we're going to ask them some questions. We got a microphone here for them as well. Let's start with Roger. He's the Chief Investment Officer at Roca Wealth Strategists in Roswell, Georgia, just north of Atlanta. His radio show is titled Retirement Cash Flow Matters. He's author of a book with a great title, Don't Eat Dog Food When You're Old. Now, the follow-up to that was don't let your clients eat dog food when they're old, right? Because he advises a lot of financial professionals. He's also a CPA and a financial planner. Roger, can you describe your typical client and some of the services you provide at Roca? What are the services you provide?
Well, ours is a pretty broad-based practice. Our typical client probably averages 65 years old. We have very few clients below 50, but there's a reason for that. Nearly all of our clients are referred by tax professionals or tax attorneys. So they know that, quote, we're the Social Security experts, we're the Medicare experts, we're the senior taxation experts, which is a point you'll probably hear me make several times in here, because I think that's one of the places where you're losing opportunity, is not recognizing that the tax professionals probably are the best, the very best source of business. So that's our typical client, 65 years old, but could be 50, could be 85 or 90.
So you have a broad base of information that you can provide your clients. Is there one aspect of financial planning that you would consider personally your specialty so that the audience knows?
Well, of course, as you can tell from the title of my books, it's retirement cash flow. I think, and you're going to hear pretty strongly from me today, that I think you're selling reverse mortgages wrong. that you're selling reverse mortgages in terms of a pool of cash. And I think that reverse mortgages should be sold as a source of cash flow, which is a very, very different subject matter. And it gets then also, Dan, into tax issues, that I even look at some of the reverse mortgage articles out there on taxes, and I say, no, they're professors. They don't really understand where the real tax issues for retirees are. The real tax issues tend to be related to things like if you have $30,000 of adjusted gross income, you might pay 0 in taxes. The next 10 could cost you $4,000, 40%, because of the structure of how Social Security is taxed, et cetera. So I really think the key issues are retirement cash flow and adjustable gross income.
Okay. Now, Roger, you're a convert, obviously, to our side. We appreciate your feedback. Can you tell us what it was that first got your attention and showed you how our product can help your clients?
Scott Gordon's probably going to love this answer. I had suspected, it was about 18 months ago, Dan, I had suspected all along that I needed to know more about reverse mortgages. And I'm old enough, but didn't want to do a reverse mortgage at the time. And so I could not get information, or good information. So I did what I always do. I went on Amazon, I bought 3 pro reverse mortgage books and 3 negative books on reverse mortgage. And the first one I happened to read was Scott's. And I love Scott's book. Not more than yours necessarily, Dan. but I loved Scott's book. And then you have to understand my personality. I read the first negative book on reverse mortgages, and I wound up throwing it against the wall. I was so frustrated because there were so many misconceptions, out-of-date things, etc. So that's what got me interested. And then I tried to contact Scott. Well, good luck. That was not easy. So I finally Googled Georgia and said, is there an open mortgage person in Georgia? And that was Dan. And I got Dan, and we've been working together ever since. We do a strange thing. We find clients that we think are candidates for reverse mortgages, and we bring Dan in, and he goes one right after another through those clients, 3 or 4 or 5 in a day. And it's very effective. I promised him 90% close rates. And we've had 2, I think they're going to wind up doing forward mortgages rather than reverse mortgages. Yeah. But I don't think we have any that are not going to do one or the other.
Yeah. There's some hesitation initially, but Roger carries a lot of weight when he gives advice. I mean, he's already done the math. He's very analytical. Before we move on to Suzette, audience, do you have any questions about Roger? Okay, Carlos has one.
Roger, a question in regards to the tax professional and adjusted gross income. I was on the seminar. I enjoyed that part. Your definition of tax professional, are we talking CPA, EA, or some of the people that are just, H&R Block, just any person that's trying to do the taxes?
Carlos, I would say all of the above. Now, I will tell you that within any one of those groups, there are people who are simply historians. They put the number on the form. They don't care what causes the number, etc. And they're not the real candidates. But if you get the tax professional who cares whether his client's paying too much taxes or her client's paying too much taxes, it really doesn't matter. We found that enrolled agents are every bit as good as CPAs, as referral sources. And even a lot of non-registered people couple of the best and we educate about 500 of those people every year. A couple of the best are just H&R Block professionals that are neither. So I would say it's all of those.
Excellent question. Any other questions for Roger before we move on? Yes.
Just wondering if Roger had any articles published that we could take into some of our financial planner contacts in our areas.
Sorry. And you, as loud as my voice is, you might not even need this. I once outshouted a Baptist conference without a microphone. So I have a fairly strong voice. Not so much articles as radio show podcasts. Matter of fact, Dan, I'm amazed that Dan hasn't said this, so I will. I interviewed him on 2 of those shows. And those were 2 of the most popular radio shows that I've done in the last 6 months. And we're going to do some more. Now, Dan and I are talking about a couple white papers that we're probably going to do.
And we're going to get to some of that later. He has some concepts that I know some of the academics have not explored. You know, we see articles come out in Forbes and Wall Street Journal pretty much weekly now, right? Okay. They're missing some things. And so hopefully we'll be able to fill in some gaps. Let's go ahead and move on. And let's talk to Suzette for a little bit and get to know Suzette. I'm going to click on to the next slide. Suzette there is owner of Capstar Financial right here in Austin, Texas. She has a radio program titled Financial Wise. Now you have a tagline with that. Can you tell us?
Some folks are financial wise and the rest are otherwise.
I love it. I absolutely love that tagline. Yep, speaking the microphone. She has over 20 years.
As he is.
She has over 20 years in financial planning. She's an investment advisor and financial planner. So Suzette, I'm going to go through some similar questions so we can get to know you as well. Can you describe your typical client and what services you provide at Capstar?
Sure. My client base is a bit younger than his, just simply because my target audience is people within 10 years of retiring. Because what I see to be the top priority in retirement is that 3 things. We're living longer. There's medical technology that's keeping us alive longer, not necessarily healthier. The second thing that I see is the government is getting away with quote unquote loopholes. And they're not loopholes. They're things that are set up so that we could take advantage of different aspects of Social Security, different aspects of the tax code, different aspects of estate planning, and they're closing those. And the other thing that's very disturbing is the means testing. And I'm sure he'll speak to that as a tax professional. Medicare is means tested. Your prescription drug card is means tested. Those are all tax issues. And on my radio show, I talk a lot about the 10 golden years of retirement between 60 and 70. Your IRAs become available without penalty at 59 and a half, and you have to take a required minimum distribution at 70 and a half. So you have 10 years to fix the mess, or you come see me at 50 and we fix it before you get there. And that's part of what we do at Capstar. I don't know if I'm the premier expert such as he is in my entire town, but one of the things that I do know is that when we meet with people just like he does, we're talking on, you know, the majority of financial planners, if you go to a stock brokerage house that is not an independent house, like a Morgan Stanley and Ed Jones, a Merrill Lynch, they're all about assets under management, have an aggregate, and then at retirement, just peel off 4%, cross your fingers, we hope we do well. If he's a firm like I am, we're looking for income streams that never end. I have a question. What are you more afraid of, death or running out of money? Okay, running out of money. You're not alone. So, you know, if we're going to live well into our 90s, if you're married, between you and your spouse, one of you will live into your 90s. So if you retire in your 60s, that is 30 to 35 years without a paycheck. So we have to find alternate sources to give you income. Do you think the stock market's going to be the only source? So, you know, this is a big part of this asset class.
Suzette, is there one aspect of financial planning that you consider to be your specialty? You've already covered a little bit on that, but what would you specialize in?
Income planning. Income planning. And not just, we are an independent insurance firm, so we do annuities, life insurance, overfunded life, things of that nature. But we also do investments. And we're looking at alternate investments, senior loans, REITs, stock market, preferred stock portfolios, very managed accounts, things that are active. As you know, the market's very different right now than it was even 4 years ago. You can't have everything in oil stocks right now because obviously it's half what it was a year and a half ago. So you have to be active. Buy and hold kind of doesn't do it anymore.
You can notice already that both of them have an interest in retirement cash flow, so you can understand why they're naturally attracted to the reverse mortgage product, because we can assist them in that specialty. And so my guess is, if there's one aspect of the reverse mortgage product that showed you how you can help your clients, is simply cash flow, right? And taxes.
Well, yes, but it's no cookie cutter deal.
Right.
I mean, I was talking to you offline. We've got clients that need to get their houses paid off so that they don't have that line item of a mortgage on their budget. We've got people that need additional income. They've got plenty, but they want to do a reverse and buy a rent property for more income streams. We've got people that are ill. I've got a client right now, the couple that she was just diagnosed with Alzheimer's, and doesn't have enough money to pay for that $7,000 a month bill. So I don't have a one size, the three circles are what, when we sat down together, really changed my whole view on this.
Okay, that's great. She said Alzheimer's. We're looking to get a conservatorship, right, or guardianship before we apply. See, those are the types of things that maybe we can advise in that situation. That's great. Audience, do you have any questions for Suzette before we move on? Yes.
Well, I can tell you right now, and I'm sure he would believe this to be true, if we don't understand it, we're not going to recommend it. I'm telling you that right now. I mean, I've done lots and lots and lots of tax strategies, and people say, I want to go back to my CPA and check it out. My first thing that I do as a financial planner is I go to the CPA and I go, let me explain to you what I'm doing. Let me explain to you the benefit to the client for doing this move. I don't talk about any of the, all the details. The details aren't important. It's how is it going to benefit the client first, and then you go there, because they won't hear you. If I could make one recommendation, and I've gone to, some of you guys have done meetings in town, or I've watched webinars or all that kind of stuff. You guys are way too technical, way too technical. You need to tell stories and figure out the benefit to the client. I don't care about rates. Okay, I care about what is it going to do for the client first. Then I'll go there with you.
Let me pause you for a second. Did you hear some of the words that she said about details and how you want to know the end result? Does anybody want to know how she tested in the Discovery Insights? Because if she's red yellow, is that right?
It is.
She's red yellow. Was it red yellow or yellow? You were red yellow.
I was yellow red.
Yellow red. Okay, so if I'm communicating, applying what we learned yesterday, I'm communicating to this financial planner. Am I going to give her tons of spreadsheets? Am I going to send her every article by Wade Fowle, Dr. Salter, Jerry Wagner? Am I going to send her all of that? Or am I going to say, what does this mean to your client? And give it to you in about 3 or 4 sentences.
Mm-hmm.
Okay?
That's what Cap is really asking, was what was the best way to be able to get in touch with and have a time to be able to talk to them. And I think Suzette was just answering it.
Yep.
More about the client testimonial and how that's going to work for their scenario is her answer.
We're going to get to that because we're going to talk about 4 of them, actually, one of them that has not been explored, and we're going to get to that a little bit later. But, personality-wise, they're a little bit different. Every financial planner is going to be a little bit different. I asked Roger on the phone the other day, how much detail do you want on every one of your clients? About once a week. Give me everything you got. Okay, so that's a little different. And so you need to be aware of the personality types, which we discussed obviously yesterday. Let's go ahead and get on with the presentation a little bit. We've had a great discussion already, but I want to talk about where we should always talk about as professionals. We want to start with addressing the concerns of our clients. So audience, what's their primary concern? We've already mentioned it. Cash flow, running out of money. Yep, you'll get this one as well. Running out of money, yeah, that shows up as one of their top concerns. There's some others that are listed. There are all kinds of charts that show what are retirees concerned about, or people leading into retirement. What are their primary concerns? Roger, you mentioned something the other day that I thought was very important, though. He said what they're concerned about and what they should be concerned about may be two different things.
Yeah, what I was talking about there, Dan, is if you listen to one of the brokerage houses, and I'm going to pick on Fidelity, and Christmas last year, they had a whole week on retirement from Fidelity, and the big thing they had was you need $800,000 to retire. Now, to me, that's a pretty big generalization. You need $800,000 to retire. But I would submit to you there are lots and lots of people that $800,000 isn't nearly enough. You have to look at what are their other sources of income. You know, if they're going to get a $1,500 a month Social Security check, that's very different than getting a $3,500 a month Social Security check. If they are a federal or state employee and they've got a pension, that makes a world of difference too. So to me, and we've already said this, it's about how much, and there's a great term for this. It's called mailbox mentality for clients, which refers to the fact that they want to know that what comes into their bank account on a monthly basis is greater than what goes out on a monthly basis. And I'll give you a classic example. Somebody who retires from the federal government or in the state government in Georgia, where Dan and I live, could retire with virtually zero savings, and they'd be in great shape. I could give you a half dozen clients off the top of my head who at 65 had zero, and at 75 they had $300,000-$400,000. Ran into one the other day that between 65 and 75, they wound up with $414,000 in their Bank of America account because they never had so much cash flow before in their life. So I think the focus is always on assets, and the focus should be on cash flow and income and taxes. I'm going to relate a story to you. I had a CPA call me last April 15th, a year ago, and he was obviously in a hurry. Last year was not one of the years where April 15th was the deadline, I don't think. So he had a day or so left. And he said, I got the client here, so I want to tell you that. They're going to listen to what you have to say. We don't have very much time. I told them to take $30,000 out of their retirement IRAs, and they would owe no taxes. And they took 40 out, and they owe $4,000. Tell them why. Now, what he was just asking me was to reinforce the fact that when they took that $10,000 out of their IRA, they also subjected $8,500 of their Social Security to taxation. So it wasn't taxation on an additional 10, it was taxation on 18.5. Now think about it with a reverse mortgage. What if they'd gotten that $10,000 extra they needed with a reverse mortgage? They'd have paid zero taxes. So to me, it's all cash flow and taxes. That's an oversimplification, but those are the two most important factors, I think. And that's why, Dan won't tell you this, so I will. We had him speak for an hour to a group of 50 CPAs, and he wound up speaking for 2.5. And it's because tax professionals get it, and they don't have any competing motivations. They're not typically salespeople. They're not investment professionals calling themselves financial planners. They're just there to represent their clients. And you know who the first people are that do reverse mortgages? And I noticed Sue said the same thing in her presentation, the CPAs themselves. Can I tell the one story?
Sure, absolutely.
One of the CPAs raised his hand and said, let me get this. I have a paid-for house. Now, we live in Atlanta, so paid-for houses tend to be expensive. It was probably a $500,000 house. And he said, if I incur a little bit of closing costs and the federal government costs for the insurance, I can do a $500 loan on a reverse mortgage. And in 10 years, I basically have twice the line of credit. And in 20 years, I have 4 times the line of credit. Am I getting this? And of course, Dan wanted to say, I know he wanted to throw his hands up and say, hallelujah. Can I hire that guy to be a straight man for me?
Absolutely. You know, these are the kinds of conversations that those of us who have been in the industry for a while, in fact, during the break, John, I think you and I were talking about, we didn't talk about sustainability even a few years ago. The conversation with reverse mortgages completely revolved around cash, right? Those of you who have been in the industry, it was about, okay, well, somebody wants to get a reverse mortgage. They're going to use up to 90% of their property value for our older homeowners prior to 2009. 90% of their home's value, and we're giving it to them in cash. We didn't talk about sustainability. You can understand why the reforms were needed, and now the conversation is almost entirely about sustainability and financial assessment. So we look at some of the other concerns: healthcare, scammers, bequest to heirs, tax liability, insurance, Medicare, Social Security, long-term care, low interest rates, which can be a problem for them. Those are all types of issues that we can work together to make sure that we solve some of their other concerns, their secondary concerns. So as a financial planner, you guys have to look holistically at pretty much everything. Our job is relatively easy in some respects because we're just creating the bucket that allows them to do their job. All right, any questions related to primary concerns before we move on? Any questions? Okay, let's talk about Monte Carlo simulations. Yes, financial calculations. All right, anybody excited about that? Let me see if I can articulate, for those of you who aren't aware of Monte Carlo models, how they work. I'm going to do my best, and you guys can jump in and correct me at any time, but the question becomes, is my client going to run out of money? They don't know. We don't know. There's really no way to quantify that exactly because there's too many factors. We don't know what the market rates are going to be. We don't know their longevity. How long are they going to live? We don't know what kind of financial pressures they're going to be under during that time, during retirement. So it's really impossible for us to know. Well, if we don't know, what do? You run a model 10,000 times to figure out how many times they ran out of money, right? And that's what a Monte Carlo simulation does. I'll click through these slides. Problem is, we don't know certain things. The solution is, we run it through with random rates of returns with certain constraints. We recreate those random returns thousands and thousands and thousands and thousands of times, and then we count. How many times did they run out of money at every given age? I mean, that's ultimately what your spreadsheets are doing. So when you use a Monte Carlo simulation, you're just running it as many times as you can. Sometimes you start in a bear market, sometimes you start in a bull market, sometimes it's up and down. Well, we don't know, but it's set to be random. And now we find out Mrs. Smith has a 30% likelihood that her retirement funds will last age 90. Is that good? Is that bad? Well, it's just a number, and that's kind of a starting point. Is that kind of what a Monte Carlo simulation does for you guys?
Yeah, I believe it's a little overwhelming for most clients. That's the broker world speak that you're talking about. And
Exactly.
Do you guys understand broker world speak? It's the same language you guys have, and when you start talking, your clients glaze over. And I just think it's really important that you get it down to, do you like going to the grocery store? Because this is your grocery store money. And get it simple. And that's where people can make decisions, is when it's simple. So,
Dan, I thought by letting Suzette go first, you'd get support from at least one of us. But you're not lucky, because I do not like Monte Carlo simulations.
That was going to be the follow-up question.
And I thought she maybe would be supportive of you, but
No-
neither one
no
of
luck.
us like your Monte Carlo simulations. And she said it, grocery store mentality. Remember when I talked about mailbox mentality? If you have more coming in on a monthly basis than you have going out, you don't worry about when you're going to run out of money. You just worry about sustaining more coming in than going out. Now, sustaining may need, and of course, this is one of the great selling points about reverse mortgages to me, may mean that you have a line of credit in reserve for the day, and if you live long enough, then it's almost inevitable when you need that long-term care. Because to me, that's been one of the great things that reverse mortgages have done for us in our practices. The hardest thing, I would say our clients listen to 90-some% of what we tell them. I would say they listen to us on long-term care about 25% of the time. The resistance to buying long-term care insurance is absolutely incredible. So we look for alternatives. Well, we know they're not going to go buy long-term care insurance. How do we make sure that they're okay if they have that need? I just talked to my mother a couple days ago. My dad's expenses last year for long-term care were $97,000. And they live in the middle of Nebraska, not an expensive state. My mother, though, has an accountant's mentality. She's another Blue. So I'm sure her numbers were right. A lot of people would not catch everything, but I'm sure she caught everything. But it's still $97,000 a year.
That's pretty impressive. Actually, my follow-up to that was, when you meet with clients, of course, you can't rely on this to discuss outliving their funds. There are all kinds of other variables you have to look at. That's not something we discuss with them, but maybe you discuss with them other things like longevity in your family. Roger, you got longevity in your family. I know that. Those ranchers and farmers in Nebraska live a very long time. That's a conversation that we've had. But what about their current health issues? Those are types of things that you ask them about, right? Suzette, is that a conversation you also have with your clients? Long-term care, health issues, longevity?
well, in the normal Monte Carlo or retirement analysis, or, you know, and there's a couple different things you guys need to realize. And there's a law that was just passed literally Tuesday. Department of Labor said that the RISA laws stand firm for fiduciary standards, anything in a retirement account. So your product pushers, so to speak, are going to be a thing of the past. I hope.
I hope so.
Yeah. Fiduciary standard means that you have to act in the best interest of your client no matter what. And you have to disclose all your fees and everything that you're doing, and the conflicts of interest. For what does that mean for my relationship to the client? It's almost, I mean, we have to stand for the best interest. So I stress test. You call them Monte Carlo, thousands and thousands. I stress test on what if you get sick? What if you die early? You know, one of you as a couple die early. What if there's a downturn, a market downturn in all aspects? And like you said, interest rates stay low, interest rates go high, oil stays low, and oil goes high, you know, all the different things that you want to do on that. But never before this conversation did I ever think of a home as being an asset class. I don't know if that was something that I ever really thought and put my head around. And that's, I think, a challenge for you, is to be able to communicate with us that the home is clearly an asset class and the benefits to the client and the equity that's in there. Because everybody, the way I looked at it before this conversation was, you have to have a home, you have to have a place to live. That's over here. Every suitability test is excluding the home residence. Every one. And what you're challenging us to do is introduce that conversation. So it's going to take some time to pull us in to understand that. And if you talk in your special language, you're going to blow, and we don't care, okay? You got to talk in a way that we're going to hear you, which is the benefit to the client. Okay, I hope that helps.
That's great feedback. That's exactly what we want. Roger, did you want to add to that, or?
Yeah, I do want to add to that. I want to give you a statistic, and this might help you with accountants. My dad retired in 1990. Now, Dan's right. We have a lot of longevity. Three of my four grandparents lived a long time. My dad's alive at 93. My mom's alive at 90. My dad retired in 1990. So you have a book to give him or something?
Yes.
I'm sure you have one of your books to give him, for the one who can come the closest. In 1990, when my dad retired, what was the national average on a 6-month CD? Yeah.
Someone get close enough?
She got close enough. It was 7.6 in 1990. A 10-year treasury in 1990. Take a guess on that one. Not nearly high enough. 8.2. So roll that forward. If you had 200,000 when my dad retired, you could count on $15,000 plus in cash flow on an annual basis without using principal. Roll that forward, same two instruments today, you'd average a little over 1.5. And how much would you have to get the same $15,000? You'd have to have $1 million. So the fidelity approach of how high you pile the assets doesn't work, because over time, the income you can get off those assets has varied dramatically. And it looks like it's going to be a long time before you're going to get a very good rate on a money market or a CD. I'll give you one quick story on that. The client who came in with $414,000 last week in Bank America, what do you suppose? She had 3 different accounts. And Obama administration's going after so many people for lack of truth in advertising. There's something wrong when they don't go after the Bank Americas of the world. They had a prime plus money market. Guess what the rate of return was? 4/100ths of a percent. 0.04%. A CD, a 6-month CD, 6/100ths of a percent. On the entire 414,000, the highest rate they were being paid was 6/100ths of a percent. And last year on 414, now I realize some of you are not blues like Dan, but take a guess as to what their income was last year. Under $200 on 414,000. So this is the problem with taking the asset approach. This is where your opportunity with the reverse mortgages is so great. And the CPAs are going to love you because you can show them how to regulate the amount of taxes paid. We haven't mentioned yet, but Roth conversions. And I did see in some of the materials from somebody before I got here that was mentioned as one of the potential benefits of a reverse mortgage. Absolutely.
Well, that leads very nicely into the next slide. This is really for our viewing audience over here. I know that you two have seen this before, but who's heard of Wade Pfau? Okay, Wade Pfau is the most prolific writer right now, prolific academic writing about reverse mortgages. By the way, he's a professor of retirement income at the American College, director of retirement research at McLean Asset Management. His research is coming out in Forbes every week, right? And Jamie Hopkins is publishing in Wall Street Journal. So there's all kinds of articles coming out. Now, we don't always agree with Wade Pfau. I know that we've had some differences with some of the things that he puts out, but he is the most prolific writer, and he's very, very positive on reverse mortgages. And I mentioned to somebody about this chart. Carlos, was it you that said that this chart has been duplicated a few times by other lenders in the past? But yeah, well, it's a very powerful chart, and I think it's one of the most powerful arguments for a reverse mortgage. It's simply, Dr. Pfau used a Monte Carlo simulation 10,000 times and demonstrated that the worst possible survivability or success rate is ignoring home equity. Yet virtually every retirement planner, financial planner, advisor out there is ignoring home equity, and you can see that based on this criteria on the left, after 30 years, they have a 40% chance of fund survival. Not very good, right? I thought that was impactful. For those of you who haven't seen this graph, it involves a $1 million tax-deferred retirement assets, $500,000 in home value, 4% or $40,000 in needed retirement cash flow, and that's after tax. We applied a 25% tax rate. And so he ran it 10,000 times and came up with his data. Now, these other strategies, some of you have read about. Barry Sachs, of course, the Texas Tech one is Dr. Salter. And so there's all kinds of strategies being used using the reverse mortgage, and they all win. They all win over what's currently being advised. And so I guess the question I have for the panel is, because this makes us very frustrated, is in light of the overwhelming evidence that what they're advising doesn't work, why do you think financial planners have such a hard time getting over that hurdle and considering home as an asset class?
Well, you remember I talked to you about the firm, you know, the Morgan Stanleys, you talked about Fidelity.
Right.
All right, you're an independent advisor. You own your own firm. I'm an independent advisor. I own my own firm. So we don't have a market maker telling us what to sell, what to offer. If I work for Morgan Stanley, I have to do what Morgan Stanley tells me to do, okay? The client is just the, you know, the commodity to make sure I get a paycheck from my boss. So, you know, back to the original question of who should you start talking to change this and make it more available to the, you know, humans of America, you got to start with independent advisors. We're the change agents. Now, of course, you have to preface every conversation with, oh, by the way, I'm not a tax professional. But just talking about it, you're not advising. You want to understand the difference between an ordinary income tax rate and a capital gains tax rate and where the breaks are. You want to understand, just like he was talking about, when Social Security is taxed. You know, just learn some of this stuff. And, you know, at a very high level with big, broad strokes, you can talk about that. you know, because that's what we're interested in. Can I answer this?
Yes, question.
Work with some of the compliance gurus for these firms. I know a lot of the planning software is finally starting to incorporate proceeds from a reverse mortgage in, financial income planning. But is there anything from a lobbying standpoint that we should?
Well, at this point, every suitability form that I fill out in the annuity world or the life insurance world excludes the home as an asset. I don't have one that I fill out that adds it as an asset class. In fact, life insurance, there's something called premium financing, and it actually asks if you're using funds from a reverse mortgage in a negative connotation, not in a positive light. This is going to be a boots on the ground change agent between independent advisors working with forward-thinking reverse mortgage specialists.
My understanding of some of the suitability software and simulation is that you can utilize the reverse mortgage proceeds as an additional bucket of income under the other income bucket.
Well, let me see. I actually did an example with my very simple, not Monte Carlo retirement analysis of a client that walked in with very little money, and by delaying Social Security, what asset do you have that has a cost of living every single year? Well, not every year, but most of them. It has an 8% deferred income credit if you don't take it. What asset do you have that does that? And so many times people say, just take it at 62. Well, I'm showing, and same thing with pensions. Texas pensions aren't as good as, apparently, as good as the ones in Georgia. But by delaying 3 to 4 years, but why don't people delay? Because their expenses are too high. So I've got an illustration of a client that had a $6,000 overhead, but by doing a reverse mortgage, they eliminated $2,000 off their line item on their budget so they could delay. They spent their IRA money, and now instead of running out of money at 65, they're running out of money at 85. Okay? That's a pretty compelling reason to do a reverse mortgage.
I didn't want to put Suzette on the spot here, so I'll do it and let her respond to what I say. I would quarrel dramatically with Wade's 25% marginal tax bracket. Dramatically. I think he should have used 10. Because if we use a reverse mortgage, correct, the rate should be 10.
Well, I'm going to disagree. Because we're talking about marginal tax. But here's something that you guys are missing, and you need to understand, and he'll concur. We have means testing now on all of our health insurance. When you hit 65 and you have to go for Part A and Part B, your premium is based on your adjusted gross income. The reverse mortgage proceeds are tax-free. When do you think is the best time to take that as an income stream? Are you going to need Plan D, which is your prescription drug card? That's means tested. You want to cover all these fees and PMI? Do this as an income stream. A lot of additional taxes are coming down, but they're not called taxes. They're called goofy means testing, or they're additional costs for all of this. How many of you all know that some of the largest long-term care companies in America are in receivership? Ones that we've counted on for years because of the needs. Because of the needs of the people, and they're right when you need it the most, they're raising rates up 30-40%, or you lower your benefits right when you need it the most. And this is something that we can do to offset that.
Yeah, look at Wade's example here. And Dan quite correctly pointed out you needed 4% on $1 million after tax.
If you
have 30,000 from normally taxable sources and 10,000 from a reverse mortgage, you're going to have no taxable Social Security for the couple. If there's a single person, you're going to have taxable Social Security only in excess of 25,000. And 30,000, guess what? The standard deduction and the personal exemptions for a couple are. They're a little over 21,000. So what's the tax rate going to be? Virtually zero. In a state like Texas, it probably would be zero. In Georgia, where we exclude the first 65,000 of retirement income, it would be zero. So that's why the CPA called me. He perfectly told his client, take 30,000 out of your IRAs, and they took 40. And they thought, oh, we only took an extra 10. And they were shocked that they owed $3,950 taxes on that last 10,000. Because as I said earlier, they weren't being taxed on 10, they were being taxed on 18.5.
Let me mention just one more thing about this graph before we move on to some of the strategies. I want to make sure we get through some of the slides. We talked about ignoring home equity has a terrible result, but most of the financial advisors that are open a little bit to reverse mortgages, they're going to say, well, I'm open to it, but I'm open to it as a last resort. That's the second worst strategy. So you have the majority of them that say, nope, you can't use the home as an asset class. And the ones that actually are accepting the reverse mortgage are saying, wait until the very end and then use it. It doesn't work. In fact, it's interesting when you look at sustainability or probability of success, the one that comes out the top, get the reverse mortgage at age 62 and never touch it. That's ultimately the best for survivability. It's not the best, by the way, for bequest value to the heirs. That's actually another chart. And I think you found that the 10-year and a couple other strategies work better. Question?
Suzanne's talked to this point without saying it directly, so I'm going to say it. The College for Financial Planning, those people who are CFPs, treats the home as a use asset rather than a usable asset. So the College for Financial Planning is teaching those people who get the certified financial planner designation to ignore the home.
That's great.
Didn't I read a couple years ago that FINRA actually stopped referring to reverse mortgage as a last resort?
Yeah, they started to make the term last resort taboo, but that still lingers. I mean, I hear that constantly as a last resort, and we see it in the articles. And if, unfortunately, we see it in the blogosphere as well. And a few of us are on what's called the blog squad for NRMLA. The moment articles come out about reverse mortgage, all of us get notified that an article came out and whether it's positive or negative. If it's negative, there's about 25 or 30 of us that go ahead and comment and just hammer the author. We had to do that because we saw way too much negative information, misperceptions about it. And so the blog squad has started to make it clear, we're not going to tolerate you giving misinformation about the reverse mortgage. But what we found is a few years ago, it was 3 negative for every 1 positive. It's completely reversed, and now we're seeing 5 positive for every 1 negative. And the 1 negative, generally it's not in the major media. So we've seen a major shift in the last year.
Now, the other comment about weighting the article, even if your assumption, or his assumption of using 25% marginal tax rate versus 10%, it's just going to shift the curve to the right. So probability of success, this is more conservative than what we were talking about.
Yep.
You know, this whole talk is about you getting in front of us, right? Again, I'm going to make it so crystal clear. Talk in plain English. Speak to the benefits to the person that we serve, not to our benefit, to the benefit of our client in broad strokes. And and we are tax professionals, we're income specialists, we're learning what our clients are facing. We're sitting down with families. I sat down with a family yesterday where it's the 40-year-old son with the 73-year-old mom, and she's losing her memory. And how are we going to pay for that? All right. If you come in and you're talking rates and bringing your fancy brochures and leaving that, it's meaningless to me. What I want to hear is how are you going to help Jackie? Okay. I want to know the stories you've got that are going to help our clients.
Yeah, Carlos, we got to be careful with the word conservative. The best CPA tax professional planners would say that no, 25% isn't acceptable, because why would you pay 25% when you could pay 5 or 0? And most of them are now working aggressively, and you've got several that are working with Dan that are aggressively saying 25% is just unacceptable for that client. Now, raise double the income needs. That changes the picture. But it happens that Wade's picked his example right at the level. And I guess Dan and I are going to need to write that paper.
That's right.
30 to 40,000 should not change the taxes. Now, if you have to go to double that, then the tax rate's going to be higher, obviously, because now you're going to have to tax Social Security. But to go from 30 to 40, you don't have to tax Social Security.
Well, let's get to some of the strategies. I'm going to go ahead and click. There we go. Let's talk about some strategies. We're going to start with one of the big ones. We'll talk about Social Security delays. We're going to talk about 4 of them. Actually, I'll go ahead and put all 4 on the screen. You know what? Because I'm concerned about time, I'm going to start with number 4. Roger, this is something that Roger has discussed that the academics are not talking about. And I'm going to let Roger kind of take it from here about maximizing retirement contributions leading into retirement.
Well, you're going to have 2 types of clients. One are the people in the corporate world who are still working, who have the opportunity to put $24,000 a year into a 401k and are not. And I know Suzette would say the same thing. When we ask them why you're not doing that, the answer is can't afford it. And of course, our answer is can't afford not to. But when they put the tax law 3, there was a drafting error. And everything was limited to 24,000 in the calculation except one thing. And that is what, and I hate to be too blue here, but I'm going to have to be, the code section 457B, the state contribution for somebody who's a state of Georgia or state of Texas or wherever professor. And Dan used one of my examples last night, and I loved it. Somebody who's making $55,000 or $60,000 could put 48,000 of it if they're a teacher, work for a state, and also work for a public system, you know, like a county or something like that. They can put $48,000 into a retirement account. Now, there have been a few people who've done that over the years, but they're generally the lucky few that inherited a lot of money. And they came in to see somebody like Suzette or I, and we said, take advantage of your inheritance. Put the maximum into your retirement account, which is either 24 or 48. But the reverse mortgage offers an incredible opportunity, just an absolutely incredible opportunity. Tons of these people who are still working over 62 have a paid for or virtually paid for house. What would it do for them if they used a reverse mortgage to put their $48,000 or $24,000 maximum in? At 48, and we have a lot of them in Georgia, but the two states that are considered most similar, Suzette, are Georgia and Texas. And all the providers of products and advice, et cetera, pick Georgia and Texas because the academic systems are so similar in those two states. But there are a lot of other states too. There's an opportunity to save $250,000 in the last 5 years before they retire and pay virtually no taxes along the way. It is that capitalizing on the value and leveraging the value of their home dramatically. And I guarantee you, you might not before we gave you this example, but one of your best groups to go to speak to is guess who? Your public school teachers are even better. Your academic institutions. Because what difference will it make to their quality of life if in the last 5 years of their working career, they put $250,000 into a retirement account, which they can, Carlos.
You know if that's applicable in all 50 states, or is that?
Is it all 50 states? I'll have to answer it this way. No, I don't think it's all 50 states. The drafting error was this, but Congress knew it and they chose not to correct it. So it's not like I'm saying something that was not known already in 2003. The legislation was put through in Memorial Day in 2003. You may remember that President Bush rushed to sign it Memorial Day of 2003. They knew about the drafting error by June. We're not a particularly progressive state in Georgia. Our legislature is sometimes considered to be one of the 2 or 3 worst in terms of speed of action. By July 1st, already, they had put in 457 plans in the state of Georgia, which would, for a law that wouldn't even become effective for 6 months, to allow people to double dip, to be able to contribute to both of them. So it's good. I'll answer it this way, Carlos. In any state where they are considered to be employed by both the state and the local institution, they have 2 employers and they have 2 limits.
So yeah, so when I'm in California, so CalSTRS is the big state teacher retirement system for the state of California. When I looked to see if they have that 457 plan.
It's often called a deferred comp. 457 is similar to a 401k, but it allows you, like you said, to have 2 plans at once.
And then all they need is the funding source, which you people have. And I will tell you, they will beat their doors down.
Can I share one other tax strategy?
Absolutely.
Another tax strategy, I know we're running out of time, is people have oftentimes held on to stock through this bull market that we had with quantitative easing, and now we're all this choppy waters, but they still have the stock and they want to sell it, but they don't want the capital gain. There's a big break between, if you're in the 15% tax bracket, you pay literally 0 in capital gains. All right, now there's an offset there with alternate minimum, but the point is that if you can take income or proceeds from a reverse mortgage and lower your adjusted gross income, you can cash in a tremendous amount of stock that's held outside of an IRA. For absolutely, I mean, it's a wonderful boon for people that have long held stock.
Great point. I'm going to add the other one. The other big one is to do a Roth conversion during those 5 years.
Right, when your AGI is low.
That's great feedback. That's exactly what we want. Let's back up just for 1 second. Do we have a couple minutes to talk about Social Security? 2 minutes. All right, let's talk about Social Security because I know that's one of the big ones. Question for the audience. According to the Social Security Administration website, what percentage delay their Social Security to age 70? What percent do delay to? Turns out it depends on their gender. 1.1% of men and 1.7% of women delay to age 70? Are you kidding me? That was taken directly from Social Security Administration website. And Suzette mentioned this earlier. Can you have any other investment that performs like that? Ridiculous, 8% a year. So I guess the question for the panel is, in your experience, what is it? What's the big hurdle? I know we addressed it a little bit, but what's the big hurdle? Why are people so hesitant to take advantage of this great opportunity to delay Social Security?
Well, there is the caveat that the trust fund is scheduled to go dry in 2038. So that's a pending doom that people feel. I mean, we've all heard about the trust fund being evaded. So that's it. But at the same time, you know, we've got a whole group of Americans. The millenniums are coming in, and that group is actually as large as the baby boomers. My generation, what do we call it? The X generation. There's not enough of us. I can't remember the name. But that small group is not big, but the millenniums are. And that's the group that's going to fund that sustainability, I believe.
Yeah, I totally agree. Let me amplify a little bit. I think part of it is the people who are worried the trust fund will run out. I don't think that's the major portion, though. I think the biggest one is the rush to retire. When I wrote my book, the editor said, all right, give me the top 12 mistakes people make. And my number one, after thinking about it for a few weeks, my number one was retire too early. So therefore, I need my Social Security to make the cash flow go. But guess what my number two was? Retire too early and not go back to work. You know, my editor has a great way of saying it. He says, what do you call the person who's working at a Walmart as a greeter? Employed.
One other thing on Social Security that's super important. If a married couple is receiving, and they both took it at 62, and somebody dies early, I'm just going to pick on the male, what do you get as a survivorship benefit? The larger of the two. So don't you think it makes sense to have a larger of the two? So one of my financial planning tools is to make sure if you need that check, take one of them but let the other one go later because you're going to get that bigger check, right?
Yeah, and this is it's a true false, so surely you can get this, a yes or no. One of the members of the couple, let's say the higher earner, is in poor health. Which one should defer? Because the answer in virtually every place I've ever seen is wrong. It's the one who is not in good health, if they are the higher earner, who should wait to draw Social Security. Because it's not just for their benefit, it's a survivor benefit.